Midnight in Washington, a new geopolitical battle. As midnight falls in Washington, financial markets across the globe are in a state of flux. The U.S. dollar, a symbol of economic strength for decades, is beginning to lose value, already shedding worth in the bustling markets of Asia. In Shanghai, Russian oil tankers dock under heavy military guard, delivering barrels of crude that stand as a bold challenge to America's influence in the global energy market. These actions highlight a larger, more volatile geopolitical struggle that could redefine the global economic landscape. Half a world away, gold prices surge and U.S. Treasury yields plummet, fueling a rumor that could shake the foundations of international trade. There are whispers in the financial world that President Trump is preparing to unleash a new wave of sanctions on China, targeting its economy in ways so severe that it could disrupt the world's largest supply chains. The stakes are high as the U.S. attempts to isolate China economically. The goal, it seems, is nothing short of securing the future of the U.S. dollar. However, history tells us that such a drastic move could backfire. The last time America attempted a similar strategy, the results were far from favorable. Earlier that same day, President Trump imposed an additional 50% tariff on Indian goods, citing New Delhi's continued imports of Russian oil. This decision was swift, and India wasted no time responding, with Prime Minister Narendra Modi announcing his first visit to Beijing in 7 years. This visit is not just a diplomatic gesture, it marks a significant realignment of India's geopolitical stance. Washington's attempt to isolate India through sanctions has inadvertently pushed the country closer to China, a pattern reminiscent of Russia's pivot toward Beijing when similar sanctions were imposed in the past. From a policy perspective, Trump's threats of further escalation against China aren't occurring in isolation. The U.S. already enforces tariffs on Chinese imports that exceed 50%. These tariffs have already hit Chinese exports to the U.S., reducing them by more than 30% at their peak. Even with partial truces, the decline in exports remains significant. Yet here's the key. Despite the heavy U.S.-imposed barriers, China's overall trade has not contracted. In fact, it rose 7% year-over-year in July. This signals that China has diversified its trading partners and reduced its reliance on the U.S. market, effectively countering the impact of tariffs. One area where the U.S. believes it can hit China hardest is energy. Russian crude oil, a cornerstone of China's manufacturing advantage, powers factories and keeps production costs low, benefiting sectors ranging from electric vehicles to consumer electronics. In July, China imported over $10 billion in goods from Russia, much of it oil, which subsidizes China's energy prices. Washington's strategy appears to be clear. Cut off this oil supply, and China's manufacturing costs will rise, weakening its export edge while also draining Russian revenues. But not everyone within Trump's inner circle is convinced this approach will work. White House trade advisor Peter Navarro has publicly cautioned that escalating tariffs could hurt the U.S. economy too. Many U.S. industries rely heavily on Chinese components, meaning any price spike in China could quickly contribute to rising inflation within the U.S. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.
Historically, China has demonstrated its ability to counteract American sanctions. During a previous trade dispute, Beijing restricted the export of rare earth magnets, which are critical to industries like defense, technology, and energy. This forced Washington to ease up on negotiations. Beijing continues to hold leverage in this area, as the U.S. Department of Commerce recently acknowledged the importance of rare earth flows to both the U.S. and global supply chains. Without these materials, the U.S.'s ambitious plans to reshore semiconductor manufacturing become impossible to execute. In June alone, the U.S. imported 350 tons of rare earth elements, far more than the 46 tons in May. But even that falls short of what's needed for large-scale chip production. If China restricts these exports again, the very rebuilding of America's industrial base could be undermined. On the currency front, things are looking increasingly grim. Since January, the value of the dollar has dropped nearly 9%, and according to Bank of America, fund managers are more bearish on the dollar than at any time in the past 20 years. This depreciation is largely due to reduced trade with the U.S., leading to less demand for dollars abroad. If the U.S. proceeds with sanctions on China, it could accelerate this decline. As foreign investors reduce their exposure to U.S. assets, the downward pressure on the dollar will only intensify. The Federal Reserve is already bracing for the impact. Futures markets show a 91.4% chance that the Fed will cut interest rates by 25 basis points in September. On the surface, this might seem like a minor move, but combined with trade disruptions, it could erode the yield advantage that has kept foreign capital flowing into U.S. Treasuries. If global investors pivot away from U.S. assets, demand for the dollar will drop further, exacerbating its decline. This geopolitical clash is no longer just about trade tariffs. What we are witnessing is a full-scale currency war, and the U.S. may not be equipped to win it. Trump's advisors have highlighted the potential for tariffs to generate substantial revenue, up to $50 billion per month. But history suggests that these windfalls may not benefit American consumers. The added cost of tariffs is effectively a tax, which gets passed on to households in the form of higher prices. Past bailouts and pandemic relief packages have disproportionately favored the wealthy, and a similar pattern may emerge here, with everyday Americans seeing little benefit while large corporations and asset owners consolidate their gains. Even as the U.S. pursues its tariff-driven agenda, the political landscape remains fraught with uncertainty. Corporate investment pledges from major companies like Apple, Nvidia, and TSMC may look impressive on paper, but such forward-looking commitments are not guaranteed. If political instability causes even a fraction of these investments to falter, the projected job growth, estimated at 400,000 new positions, could evaporate, undermining the economic case for continued high tariffs. The recent shift in leadership at the Federal Reserve only adds to the sense of unpredictability. Trump's nomination of Stephen Moran, a known proponent of a weaker dollar, could tilt the balance toward further dollar depreciation. This could accelerate the outflow of capital from the U.S., undermining the dollar's status as the world's reserve currency. As the U.S. edges closer to a trade war with China, it risks losing its grip on global economic power. China is already laying the groundwork for greater financial independence by deepening its use of non-dollar oil contracts and expanding the role of the Chinese yuan in global trade. Even Russia, despite facing its own sanctions, is increasingly conducting trade with China in currencies other than the dollar. This gradual shift, although incremental now, could eventually chip away at the dollar's dominance in global trade. The U.S. finds itself at a crossroads. Every step taken to weaken China's economy risks undermining the foundations of its own. Every move designed to strengthen American manufacturing could undercut the very industries it seeks to protect. The tension is palpable, and the world is watching, wondering whether the dollar will survive the next chapter in this unfolding geopolitical drama. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.